Okay, so we're going to continue with part 2 of chapter 5, financial statement and ratio analysis. And we left off, I talked about this briefly, but since no one really remembers the last 5 minutes of class, I'm going to review this. Total asset turnover, and we're looking at assets in relationship to sales. So how many sales can our assets generate? So think, for example, on a small scale, if you were a laundromat with only 5 washers and 5 dryers, you could see that your sales would be very limited because you wouldn't have enough capacity to really expand them too greatly. So you're limited to the most that 5 washers and 5 dryers could generate. But if you had enough busy enough location, maybe you could have 40 washers and 40 dryers. And that, if you've been to a laundromat in this day and age, they've only kept getting bigger and bigger. You know, laundromats used to be a relatively small operation, and today, Laundry Kingdom and certain super laundromat and certain names like that. Have you ever been to one of these super laundromats before? They're huge, and that's because bigger is better. People like bigger because then you never have to wait for a washer. You don't have to wait for a dryer. You know, it's more, and sales go up, and that's why you've seen an evolution in a lot of different stores where they open super centers, you know, and they larger and larger locations because people like big. You know, one big success of this is, do you know, before Home Depot and Lowe's, the hardware store was about the size of this classroom. That was a local hardware store, a True Value store, you may know, still around. And then Home Depot came out and just made a giant, basically a huge hardware store, and sales exploded. It's even the same with Target. Target used to be much smaller, and they started opening up the supersized Targets like we have here around the corner. And even supermarkets used to be much smaller, and now when they open them up, they're much larger scale. You think of the old electronics shop like Radio Shack, how small Radio Shack is. That was the norm for selling electronics until, you know, Best Buy came in. And Best Buy is double the size of its nearest competitor at the time, Circuit City. And what happened to Circuit City? They're gone. So bigger is better. And in terms of financial ratios, usually people laugh when I say bigger is better, but I guess I didn't preface it right. But as far as ratio analysis, if the bigger assets generate more sales, then bigger is better. So what you wouldn't want to do is have a huge facility with very few customers. Something else that's gotten bigger too is movie theaters. Movie theaters, before you were born, were one screen. Just had one movie playing. And then somewhere in the 80s, they had invented the triplex, and they had 3 movies playing. And then once you guys were born and they realized how much you guys love movies, they started opening movie theaters with 15 plus screens. And that's the norm. And even right now in our county right now, we have only a handful of movie theaters because, you know, you open up a screen with, you know, 15 to 20 screens in large auditoriums and IMAX. It puts all the smaller guys out of business. So you wind up having a few big theaters rather than a movie theater for every town, which it used to be, I guess back 20 years ago, every town had their own movie theater, but now they're more localized because people like bigger. So what you get at a bigger movie theater, you get a Ben and Jerry's, and you get a restaurant, and you get a bar, and you get an arcade, and so. Now, if you're looking to evaluate companies that are poor, make poor choices at buying assets, especially assets that don't produce any sales. So if you're in the simulation, if you go ahead and you buy extra plants that you don't need, say you only need to build 2,000 cars, but you buy you buy up the equivalent of 3 plants, and you have the ability to make 3,000 cars, but you only need 2,000 cars. You're building a whole new factory that's not going to do anything for a whole year. It's just going to sit there with all the employees and all the inventory and not build a single car. Can you see how that asset is not going to generate any sales? And it's going to lower, since your asset base gets bigger, it's going to lower your total asset turnover ratio. If we go back to the ice cream store we talked about, if you're able to make an asset that's just a refrigerator freezer, that's 10,000 rather than spending $100,000 on soft serve yogurt dispensing machines. You could see that if both shops had the same sales, the shop with the smaller asset base would have a bigger return or turnover of those assets. So the turnover is how many times can your assets turn into sales. So if your assets are $1 million and your sales are $1 million, that's one turn. And you rather have that $1 million worth of assets generate $10 million worth of sales. One way that businesses, especially retail and food businesses, can expand their sales of their assets is by being open for longer. And one way that McDonald's increased their sales is they've been encouraging more and more McDonald's to go 24 hours. And that's been a trend in a lot of fast food restaurants, expanding the hours of operation to increase sales. And luckily for McDonald's, they have a menu where they have breakfast and lunch and dinner, so they could go for many hours. And they're actually thinking of expanding breakfast all day long and all night. What would you think about that? You think that's a good idea? No, you don't like that? Well, okay. I could appreciate that. But for someone who does like their breakfast, how about, do you like any breakfast foods? Would you like your restaurants to have them available all day and night? Be- you don't ever have Brinner? Breakfast for dinner? Okay. So the reason operationally it's difficult to cook all those different meals, but some McDonald's with the newer generations, time means nothing. So for you guys, 9 to 5 is nothing. You probably stay awake to 2 a.m. or later at night, get up. This is really a very early class for you guys, right? 10 o'clock? So this is, and also retail stores try to stay open longer, especially around the holidays. Anybody Thanksgiving go shopping on Thanksgiving night? That was unheard of a few years ago. And then 8 p.m. There you are at whatever store you chose. I like to drive by the stores to see what the activity is. Hot chocolate outside. I know because I went to Walmart just to see how big the line was. It was crazy. I would have made a lot of money. Then I saw this Vine video of Walmart in, I think it was Puerto Rico, and they just bursted through the barricades and everybody just ran in the store. Did you see that video? Oh my God, I thought you were the online generation. It's sad when I'm online experience these things more than you. But later I'll find that video. And okay, I will do that. If we have time. Okay. And this is, of course, the formula. This is where you would find it on the financial statements. And we have a whole nother week of this chapter because the test is until March. So we're going to be doing a lot of hands-on work next week. So if you would please remember to bring a calculator, attention spans, and some interest. We're going to be reinforcing a lot of this work next week. Price to earnings ratio. This might be a little bit harder for you to comprehend because this is dealing more with the stock market. And the PE ratio, as it's commonly called, it looks at what investors are willing to pay for a stock. So the market price per share divided by the earnings per share. So let's think. The market price per share is actually the stock price per share. So if you were to look up, I think any company, you go on the internet and you look up the stock price, that's market price. So stock price and market price are the same thing. Then we want to look at it, we want to divide that by the earnings per share. So if a company has a $5 of earnings per share and a $25 stock price, the PE ratio is 5, or the stock is selling at 5 times earnings. And this shows you how valuable investors feel the company is. So the higher the PE multiple, the more valuable people feel the company is. If you look at some companies, we could look at Facebook. We're going to explore that. Let me get to Yahoo Finance first. Internet is a little slow today. There we go. feel like I'm on dial-up here. Do you guys remember that all? Dial-up? That's going to be a phrase soon most people won't even remember. They'll be like, dial what? Okay. Yeah. All right. So, okay. So if we go to Facebook, I think the symbol is FB. All right. Sometimes it's like this on campus where the just takes forever for the internet to refresh. It's very frustrating. Okay, so the PE value for Facebook is 111. That means Facebook is trading at 111 times earnings. That's a very high PE multiple. Would you think that Apple is higher or lower? And why is that? Okay, it's only 13 times earnings. So isn't Apple and Facebook sort of similarly great companies? Why is Apple only 13 times their earnings and Facebook is 111 times their earnings? The biggest, you were going to say something? No. The reason is that people feel that Facebook has a much bigger future potential than Apple. They feel like Apple's sort of crested. Everybody that has an iPhone and iPad has it already, and the only new business is kind of replacing your current Apple. People who have Apple, they don't see Apple's sales doubling anymore. And when your sales are, in the billions, it's probably a hard thing to double your sales. But Facebook sales are still relatively low, and they feel they have a much greater potential for Facebook to monetize their business. Because all along, for the last 10 years or so that you've been on Facebook and then got off Facebook because your parents got on Facebook and moved over to Twitter or Tumblr or wherever you guys go to get away from your parents who are now on Facebook. But all along, they spent 10 years making Facebook feel cool and limiting the amount of advertising on it so you didn't feel like you were participating in MySpace again. Because that's what killed MySpace, the over-advertising of MySpace. People just got tired of it and felt like it was a waste of time. It took so long to load and the ads were so annoying. And then they switched over to Facebook because that was cooler and sleeker and faster and no advertising. So now as they're trying to layer in advertising on Facebook, people feel that the usage won't go down, but the sales will go up incredibly. The same thing with Twitter. Does anybody here have a Twitter account? Raise your hand if you don't have a Twitter account. Okay, so half the class has a Twitter account. You'll notice in your Twitter feed advertisements now that pop out of nowhere. I get Target all the time for some reason. They're trying to, now that Twitter's a public company, they want to monetize Twitter and they have to sell advertisements. So it's a delicate balance, but if investors feel that there's real potential there, they'll drive up the price of the stock, and the higher the stock price goes, the higher the PE multiple goes. So investors like Facebook a lot more than they like Apple right now. And I guess I would agree with them because, without Steve Jobs, how valuable is Apple? Is kind of how I feel. And the proof is that iPhone C. Do you remember this iPhone C that came out? It was the plastic iPhone. I don't want to offend anybody if they have it, but it's been dubbed a failure. And one of the reasons it was dubbed a failure is Steve Jobs would say, Apple doesn't do anything cheap. Everything's high quality, high end for their products. And the iPhone C was a low end product. They priced it lower end, they made it out of plastic, and quite frankly, most people were embarrassed to carry it around. Because if the phone is a representation of you, and do you want to carry the lesser version of it? And overwhelmingly, most consumers said, no, I'd rather pay the $100 than get the iPhone 5, like you. Right? Would you be seen dead with the iPhone C that's pink? Okay. Because it would take some cool points off of you. You're like really high at the cool points with the Mac Airbook and the iPhone 5. I mean, you're up there. I have the whatever this thing's called, a netbook, so I'm low on cool points. But I do have an iPhone 4, so yeah. I'm sorry, what is Nokia? What do they make phones? Yeah, I haven't heard of them. Are they like Blackberries? Okay. And this is let me move this down a little bit. And this is we're taking the stock price divided by the earnings per share. And the earnings per share, as you remember, is the net income divided by the amount of outstanding shares. So if the net income is 162, we have to divide it by 100 outstanding shares. So we get the earnings per share. So for this particular company, they're 12 times earnings per share. Okay. And we have another market to book ratio. Book value is another term for equity. So book value, or we're looking at the assets minus liabilities is our equity, is also our book value. And we want to look at the book value per share in comparison to the market price or the stock price per share. Now, the book value per share tells me if I was to buy a company all by myself, I bought all the stock, I completely 100% own the company, and I wanted to take that company I own and I wanted to close it down. I want to sell all the assets, pay off all my liabilities. The amount of money I'd have left over is called book value. So and sometimes corporate raiders would do this. They'd find a company that had a lot of assets and maybe a certain amount of liabilities. But as long as the assets were greater than the liabilities, if the stock price of the company, say, was $5 a share and the book value was $10 per share, I could buy that company, sell all the assets, pay off the liabilities, and make a $5 per share profit. So most companies don't trade at a discount to book value. Most companies trade above their book value. So it's a rarity to be able to do that. But every once in a while, a company gets into distress, the stock price goes down very low, and it's an opportunity to someone buy the company, sell off the assets. And this happened recently, not so much through someone buying the whole company, but do you remember a company called Hostess that makes Twinkies, that made Twinkies, and do they make Ring Dings, or is that Drake's? Well, I guess Twinkies were the signature product, and they also did Wonder Bread. So when they went to bankruptcy, they sold off the assets to the company. So one company bought Twinkies, another company bought Wonder Bread, another company bought their truck fleet, another company bought their factories, and they just sold off the pieces of the company to raise some funds, pay off their debts. Unfortunately, they didn't have a book value, so all the sales went to pay off a portion of the debts, not the complete debt. But anyway, this will show us how willing investors are to pay for the company, or how valuable they feel the company is. And the higher this ratio, the more valuable they feel the company is. So if a company has a book value of say $10 per share, and the stock price is 20, it only has a market to book ratio of 2. Not very popular. But most companies will run a market to book ratio more around 10 or even 20, which shows that if you're willing to pay much more than the equity of the company, you feel there's future potential. You know, for example, you may want to buy a pizza store. And they're two pizza store with equal assets. They both have an oven, same amount of tables, same amount of counter space, same amount of cash registers, same amount of fixtures. So the assets are equal. One store you're willing to pay $500,000 for, and one store you're only willing to pay $100,000 for. Why? If they both have the same amount of assets. Well, the reason is the one store is much busier, and their assets produce more profits and more sales. So you're willing to pay more times the actual book value, or the value of the paid off assets, than the other store. So companies with a better future potential or better profit potential will have a higher market to book ratio. And it's similar in PE ratio, where it's a measure investors, how much investors like a company. Yeah. Okay, so there's and this is basically the formula: equity divided by the market price, the stock price per share, divided by the common equity, which is divided by the amount of outstanding shares. Because we need the equity per share, which we can also call book value per share. EBITDA. This is an acronym for earnings before interest, tax, depreciation, and amortization. We covered depreciation in another class where that you understood quite clearly depreciation is we're monetizing depreciation on the accounting side as a decrease in the value of assets as they age or get old and they're just not worth as much. Amortization is like depreciation, except it's based on non-tangible assets like trademarks and characters and things of that nature. So it's a representation of the value of trademarks. Like, what is the Coca-Cola trademark worth? The Pepsi trademark? How much is, say you could have a character like Iron Man, who's basically an intangible asset. And before the Iron Man movies came out, it wasn't worth nearly as much as it's worth today. Today, if you were to sell the license or the ownership of the Iron Man character by itself, it would sell for billions. Because the last movie made like 1.4 billion. So the character is very valuable. But go back to, say, the year 2000, before they made any movies with this character, you could probably, if it was for sale, you could probably get him for a few million. That's why back in the 90s, Sony got the rights to Spider-Man for next to nothing, only a few $1,000,000. And the same thing for Fox, got the rights to X-Men movies for only a few $1,000,000. And Marvel was so desperate, they're going into a bankruptcy, they were selling the licensing rights to their trademarks. And then the amortization, they'd have to write that down in their books because to them, the character's worth less because they gave the rights to somebody else, so they can't profit from movies or TV shows in those characters. And that's one of the reasons you see so many superhero movies today. You ever wonder why there's so many Marvel movies? Spider-Man, X-Men, Avengers, Captain America, Iron Man. Am I missing anything? Think hard. Thor, that's a big one. It's because all these movie studios had, multiple licenses. And if you look at the DC characters, which have been owned by Warner Brothers for the past 30, 40 years, they came out in the last few years, they've only come out with a Batman and a Superman movie. Oh, and that horrible Green Lantern movie. Don't see it. It was really terrible. Okay, so that's the acronym. So financial analysts like to look at this number because it's a better representation of what the company's worth. And it's more of a clearer representation of the cash that the company generates from operations. And this, because that's what we really want to know, is what kind of cash the company generates from its operations. So when I buy a business, not that I buy businesses every day, but I used to analyze businesses for other companies to buy. I always would look at the EBITDA, or what the cash the business generates. Because, like I told you before, net income is manipulated lower to reduce taxes. So if you look at the EBITDA, you get a better idea of how powerful the business can be. For example, a business may have a net loss because they have a lot of debt. But if the operations are substantially profitable, a capital group may come in and buy the company, pay off the debts, so they have a really profitable operation. And then after the operation proves profitable for a while, they'll spin it off to somebody else and resell it, or have an IPO. Similar things have happened recently with two companies. Burger King and Dunkin' Donuts were bought by private equity groups that fixed the companies up, then made them public and released them. And they're quite successful public stocks. I can understand why Dunkin' Donuts is successful. I can't really understand why Burger King is successful. Because I never see anybody in that restaurant. Maybe they're popular elsewhere, not so popular. Long Island's a very tough fast food market. There's so much competition here that a lot of fast food franchises just won't set up shop here because the competition is too stiff. That's why you don't see Arby's. Or you don't see, I think we have a Sonic now, but there's not many of them. Dairy Queen, Chick-fil-A, Hardee's, Carl's Jr. I only know of them from the commercials. Oh yeah, there used to be a Red Robin at the mall over here, but it closed and became Fridays, TGI Fridays. But yeah, it's a very competitive market for food in this area. Okay. So if we're looking at, let's look at a company. Here's we look at the industry. So the industry can have an average. So it can take all the stocks in the industry and create an average. Just like it can take all the students in the business program and I can create an average grade point average. So if you want to know how well you're doing in this program, do you have any friends that go to an easier school and they tell you the GPA is 4.0 or they're on the dean's list, but you know that they're going to a less competitive, more easier school? So even though your GPA may be 3.25 and their GPA is say a 4, your GPA actually means more. For example, if that student were to come here and take the same class as you had, they may only have a 2.5. So it's sometimes when you look at individual company to individual company, it's like that. You can't look at, you want to have, for example, a better description of this. If you look at different companies from different industries, you can't compare their financial ratios to each other because different companies from different industries have different averages and different strengths and weaknesses, so they're not comparable. So you want to compare yourself with a like industry, just like you would want to compare your GPA to everybody else in the program. So if you say you felt really bad that your GPA was 2.75, but then you found out the average for the program was a 2, then you say, you know what, I'm doing above average. Or if your percentile performance on your GPA was 80%, a 2.75 with an 80 percentile meaning that you did better than 80% of the other people in the program is a lot more significant than, say, a 3.5 where you're at the 10 percentile, where 90% of the students in the program did better than you. That's why college recruiters for graduate school look closely at the universities you attend, and they kind of know if you're coming from Wharton or NYU or Columbia, Harvard, Yale, Princeton, that the GPA you have from there is not comparable to schools that are not in the Ivy League. So anyway, you have your industry average, and then you have Excalibur, which would be a company in the industry. So we can compare now, these profitability metrics to how they do in relationship to the industry. So if we look at this, the gross profit margin is higher than the industry. So right here we can see gross profit margin is higher than the industry. Operating profit margin is higher than the industry. But the net profit margin is lower. So the first question I'd ask is, why is their net profit margin lower? And the answer has to be that they have maybe a lot of debt, paying a lot of interest, or maybe they have inefficient, a poor tax accountant and paying more taxes than they need to. Return on assets is 6.4%, which is below the industry, and return on equity is 9.5%, which is lower than the return on the industry. So if you have a low return on your assets or your equity, that could be a productivity problem, an efficiency and productivity problem. So which you might be noticing in a Zoom simulation when we go over the results. You could be looking at your results and say, I had a similar market demand. I sold similar amount of cars. How come my points and my ratios aren't as good? And one of the reasons could be efficiency. Your capacity utilization on your factories, your overspending in advertising. It's just the small details of efficiency in certain areas that can really hold your company back. So even though everybody here is on the equal footing, it's these small efficiency differences between companies that create a huge distance in the amount of points you earn and the returns on your ratios inside the simulation. So let's look at liquidity. So here we could see that current ratio and the asset test ratio. Excalibur beats on the current ratio. The higher the better on these liquidity ratios. So Excalibur beats on the industry on current, but in the asset test they're lower. So they're not as good in the asset test ratio. So if I saw this in any company I was analyzing, the first thing I'd go to is look at inventory. And if inventory is inefficient, your asset test ratio, or sometimes called your quick ratio, is going to be lower than, say, the average. So that could happen in your simulation too. If you have a lot of cars in your inventory that you didn't sell, you may have an unexpected deficit, and you may have higher I don't think they calculate the acid test ratio, but if they did, you would have a lower acid test ratio because, and you'd have a lower current ratio because you'd be having all that leftover inventory is now an asset on your books. And that asset on your books means that you have a bigger asset number, which is going to lower your total asset turnover. It's going to lower your profitability on your assets, and so it affects many different ratios in the simulation. So that's why your forecasting has to be as on target as possible. And that's why you don't build extra cars you didn't forecast to sell. I saw this in a few companies where you forecasted 1,500 cars, but for some reason you built 2,000 cars. Why would you forecast, one number and then build extra cars? And then your students would say, well, just so I have them just in case. Well, there is no just in case. Either you think you're going to sell them and you forecast them, or you don't build them if you don't think you're going to sell them. You don't try and build up your inventory. It's of no value to have a big inventory. Okay. So debt to equity, and they have a lower debt to equity than the industry, which is good. You want to have the lower debt to equity, the debt to equity. Yeah, the lower debt to equity you have, the better. Too much debt relative to the can realistically afford. All right. See, that's a funny thing. For most companies, it's beneficial to have some debt. So you don't want to eliminate all debt. You just don't want to binge on debt. You don't want to take much more debt than you really need. You want to take enough debt that can help your company grow, build new factories, invest in operations. But you don't want to take on too much debt too early on, which is going to really jack up your interest rates and suck out a lot of your profits in interest payments. So there's really a balancing act between how much debt you hold and how much new equity and stock you're going to sell. So taking it too far to an extreme can really hurt your company. So that's why we always want to look at, some industries have a higher amount of debt than other industries. And industries like the auto industry that require a lot of fixed assets to sell your product and a lot of operational investments, you're going to have typically a little bit higher debt when you're starting out because you're buying all these physical things rather than a company that just runs a website. You don't need to have as much physical inventory and physical assets if you're running a website. In fact, if you're running a website, you don't even have to buy servers anymore. You could just pay another company like Rackspace to host your website. Or you could have a subscription to one of these sites that helps you build a website and can run it off of their platform, and you just really have to just come up with the ideas and I guess a product to sell. Does anybody here sell anything online through eBay or their own website? Or you do? eBay? Amazon? So you're an Amazon reseller? Oh, wow, that's pretty cool. Entrepreneur here. Can I ask you what you sell unless it's too embarrassing?
Mostly a lot of like the textbooks. I sell them on there instead of selling them back to the bookstore. Get better.
Oh, okay. So you're your own textbook.
Yeah, and just like a lot of other stuff that I have. Just a lot of stuff around the house like I'm not going to use anymore. Just like movies,
So
like
so they set it up sort of as a competitor to eBay.
yeah.
Yeah. Yeah, I've always wondered about that because sometimes I'm buying something from Amazon and it says it takes me to another reseller and they have like a rating and I'm like, who am I buying from? But like,
The marketplace is from like a seller outside of Amazon, and they might actually send their stuff to like Amazon headquarters, and Amazon themselves will ship it
oh,
out.
okay. If
But
they're
most
big
of
enough. I knew a girl, she wasn't using Amazon, she was using eBay and she was making jewelry. And this girl was very entrepreneurial. She had a series of like YouTube videos on how to make jewelry and different designs she had, and then she had an eBay shop or whatever, and she would sell through the eBay shop, and she was selling $50,000 worth of jewelry. She'd been operating it for like 3 years, but she got up to $50,000 worth of sales just through eBay and the YouTube channel, and so some people can be entrepreneurial. I guess jewelry can sell. Who knew? You know.
some jewelry like they now it's like more Etsy sort of thing, like making your own kind of like arts and crafts sort of
Right.
thing.
It has to be unique and special. You don't want to have a mass produce. But if anybody lost a Tiffany chain with a heart on it. It's in my office. Did anybody lose that? Did you lose it? No. I don't know. My TA brought it up to me, and it's in my office. Somebody lost that. I don't know. Uh, where is Lisa? Oh, there you are. It's the hair change color that throws me. Um, okay. Going into the asset activity, we could see that their average collection period is 108 days versus 90 days for the industry. So the problem with that is they're not collecting their money as fast as the industry. So they need better collection policies. Maybe they can hire somebody to make phone calls. They could do, say, get some credits if you pay early, or some sort of incentive or a better evaluation of who they're lending money to and the credit worthiness. You see that the inventory turns are lower, which is not good, which is indicative of having a high amount of inventory compared to the industry. The fixed asset turnover is a little bit better than the industry, so they must have a smaller asset base. And the total asset turnover is less than the industry. So that again is looking at the inventory as assets. So the fixed assets are actually performing better than the industry, but the total assets are less than the industry. Again, indicating an inventory problem. And also, if they have a slow collections period, their accounts receivable is bloated and higher, and that's also going to affect a reason for a lower total asset turnover. If they have a very big inventory and a very big accounts receivable, the company is going to have a lot of assets that they're not really turning into profits. So what this company wants to do, they should be doing is focus on selling their inventory down lower and collecting their money. Can you imagine 108 days? It's over 3 months. 3 months and 18 days you're waiting for your money to be collected. That's very inefficient for a business. Typically 30 to 60 days. And this would be something they could probably clean up pretty easily. A little effort. If we look at the stock price, market value ratios, their price to earnings is the industry's 18 and they're 12. So the average of the industry, people are willing to pay 18 times earnings for these companies. But for this Excalibur, they're only willing to pay 12 times earnings, which signifies that investors are less happy with them and less willing to pay a high multiple for the company. So they don't see them as valuable as their peers. And the book to market, again, is the same situation. 2.5 times is what they're willing to pay. 2.5 times the book value per share is what people are willing to pay for the industry average of these companies. But this company, Excalibur, is underperforming the industry by having only a 1.18 market to book. So investors, again, are just saying that they're unhappy with the way this company is being run and the future prospects of the company, and the stock price is taking a real beating. So again, if you were looking to invest in this company or buy this company, this might be enough information to say, okay, there's got to be a better company in the industry to buy. If this one's sort of on the bottom of the ratios, on the averages of the ratios, I want to look for the company that's more closer to the top, because they're doing better, and that would be sort of the winner of the industry. Okay, so looking at valuing companies, especially through financial information, they came up with this additional measure called economic value added, or EVA for short. And what we're looking for is the amount of profits earned after all the costs have been subtracted, including the cost of the funds that were utilized to run the company. So what this is really basically saying is, let's take the earnings of this company, but we want to also subtract out the cost of any equity and the cost of any debt to see what real economic value they're adding back to investors. So it's a closer measure to the true economic profit. When they say economic profit, they mean the wealth the company is generating. In the more realistic terms, because accounting can't be trusted, because it's all predicated on reducing your net income to reduce your tax exposure. So looking at the economic profit, we get a closer idea of what the company is generating as far as value. In the economic value added, we know that the cost of borrowing money is interest, but the other factor is the cost of equity or issuing stock. And the cost of that is related to how much return investors are expecting to get back from that stock. So if you buy a share of stock, you expect a return, 5% or 10% return on that stock. You don't buy a stock because you're expecting it to go down. So the cost of the equity also has to be a factor in what type of value the company creates. So if the company can create enough profits to cover the cost of the debt and to cover the cost of the equity, the remaining money is the economic value added. Okay. Now the market value added is another measure, and these we're going to be calculating, working on in class. The market, I'm just going to read the slide for this one. The market value, then I'll explain it to you afterward. The market value of the firm, debt plus equity, minus the total amount of invested capital. So what it's looking at is, when I say invested capital, that's the money people originally brought to the company to buy the bonds and to buy the stock, or the equity that was originally brought to the company. So that's the invested capital. So they want to look at, what's the market value compared to the investment capital. So the market value is easy. It's just really the stock price times the amount of outstanding shares gives you the market value of a company. So, if you're looking at Microsoft and it's a $30 stock and they have 10 billion shares outstanding, it's a 300 billion value. The company's valued at 300 billion. Now, if the total value, say Microsoft, they have no debt because they have so much cash, there's no debt at Microsoft. So it's all invested capital or the original equity brought to the company. So if the original equity brought to the company is 100 billion, but the company is currently worth 300 billion, they created 200 billion of market value added, or additional wealth that the market's generated, and this basically gets generated when the stock price increases. So this is a measure of, is the company able to increase the stock price above the level at which people put money into on the stock initially, or the equity brought to the company initially. So this is looking at value added from the market side, from the stock market side. Bonds trade too, and their market value fluctuates as well. So stocks and bond values fluctuate. So they're just really looking at the current value of stocks and bonds that the company holds versus its initial starting point. And if it's greater or growing, then the company's generating market value. And the better projects the company takes on and the better profits they generate, the higher the market value they'll have. All right. Yay, the lecture's over. But the class is not over. So let's move over. I'm going to move over to the simulation now. And we'll talk about how people did with that and answer questions. Oh, it's right here. And I'll review the results with everyone. And I'm so pleased that we're able to get the first round done successfully, and people did generally very well in the first round. So I'm going to go to industry charts. And you have all these charts I'm showing you here today, you also have access to. So this is our industry for round one. And these are the net profits. So you can see here that there's no negative net profits. Every company made profits. You may not be able to see your company here. They're all listed down below, but it's kind of small. For example, this company here, I think it's Cars LLC. They had the highest amount of profits. Is anybody from that company in class today? Okay. Very good. You guys had a tremendous amount of profits compared to the industry. We had some other Island Autos, Bloom and Noto. That must be, where's Noto? He's here somewhere. There's Noto. That's your company. And Bloom sitting next to you? All right. You guys did good. So those are sort of the top companies and profits. And your profits are right around or above 10 million. So that's what we're talking about. That's what you guys are supposed to be doing, is focusing and increasing your profits. If you're in the lower half of the scale, you need to focus on why is my profit so low? Maybe your profit margins when you designed your cars were low. Maybe you overspent on advertising. So Things to think about. Okay, so let's moving on to points per team. So teams with high points, again, Island Autos, Bloom and Noto, DNA Sales, Stony Brook Auto. How original. I've seen like 16 companies name that. It's not terrible, I mean, but it's just I'm bored with it. Phoenix Autos, but I can't really be bored with your results. These five companies have really we're looking the scale on the side. The overlay is covering it a little bit. Is some teams, these five teams are close to, or somewhere between 850 and 900 points. And remember, you just need, what, 2,600 points to get the full score in the simulation? So some companies are almost more than a third of the way there, and we still have 5 rounds to go. People who performed in the lower brackets under, well, anything above 450 points is actually really good. What is 450 points times 6? 2,700. So you think of it that way. If you can score at least over 450 points, you're going to get the full points for the project. So even though you may not have the highest points here, if you're scoring somewhere between 400 and 450 points, which just about everybody except 2 companies did, you're still well on your way to getting an A in this project. Okay. No one has negative points, so I guess that's a positive. All right. What are some things that the companies who did very well in their profits and their points, what are some things you guys have in common that made you successful? And I'll tell you right now. I did a survey in my mind and just kind of thought about what you would have done based on previous classes, what they've done. And it always comes back to, one, being engaged and doing the practice rounds. And some members of some teams do those practice rounds 2 or 3 times a full set. It comes to watching those YouTube videos I created and getting an idea, or watching me set them up and going through multiple rounds and getting ideas and hints from the YouTube videos I create for the simulation to help you guys. And it also comes from reading over and understanding the user guide. So these are areas where commonality the successful teams have. And another really important factor is the teams acted like a team. Some of the teams who perform very poorly, when I have interviewed them in the past, they would say, well, it wasn't my fault. It was Chester's turn this week to do the simulation, and me, Susie, and Jane had off. And so you should be talking to Chester because it was his turn to do the simulation this week because we take turns. Every week, a different person does the simulation. Those are companies that fail. When you don't use the collective power of your team and you try to divide and conquer the work, so you have to do as little as possible. And your team usually has as little points as possible if you have that attitude. So typically I've seen the teams that work more closely together tend to have higher scores than the teams that don't meet in person, don't talk, and just kind of divvy up the work. And it's even bad if you say something like, I'm going to do the sales, Jane's going to do the marketing, and then Roger will do the production page, and then Sarah can do the finance page. And you just each individually do your own page and submit it. That's a recipe for disaster. Can you imagine a company where the sales department doesn't talk to the marketing department and doesn't tell them what they need to market or how they should, or what the cars are about or what they should be selling? Or, the marketing department not telling the production department how many cars they're expecting to sell based on their advertising levels? We're going to heavily advertise this product, but we didn't tell production to make any more of it. And then nobody telling finance how much money they need to raise to pay for all that, the investments and marketing they're doing. So you can see how logically a company in the real world would not do well in this strategy, but so many teams try to pursue this type of strategy that it's not going to be successful. So I think the colors kind of follow you. Yeah, so the colors do follow. So let's go to, this is stock price per team. So one team here, Cars LLC, Eugene, it's your company, had terrific amount of stock price. And we have Noto and Bloom. So you can see a commonality. The teams that had very high profits are having very high stock prices. And then we have, I don't want to point them out, but there's a team down here should really look at reevaluating their life and reevaluating their team performance And because there's a real breakdown. Investors just don't like. There's such a. I've never seen such a big gap between. This is like the whole class up here. So investors are really shunning your company for some reason. So you may want to think about why that is. And if we look at sales per team, number one sales is Phoenix Autos. Now they're not the number one company in points. They're not the number one company in profits, but the number one company in sales, which is not a bad thing. But remember, I'd rather have a company that has 100 million in sales if I'm taking home $60 million in profits than the company that has $5 billion in sales and only $10 million in profits. You see how that works? So there's some companies that are very low margin, and they can have huge amounts of sales, but they're very low margin. They don't bring a lot of profits home. And that's why, say, the airline industry has had problems in the past because they used to run their companies in such small profit margins that their stocks never did very well, and it was very easy for them to have losses or bankruptcies because the competition was so tight for air travel that even today, if you're going to fly somewhere, there's plenty of websites you can use to compare all of the what all the charges are for the flights, and you generally pick the lowest, right? So say you were flying home to, does anybody live in a different state that would have to fly home to? What state? Oh, it's only if you're in Pittsburgh, right? If you're in Philadelphia, you drive. If you're in Pittsburgh, that's like 3 hours from, it's a long state. Upstate, I guess if you're in Buffalo, but how about someone who lives in a foreign country and has to fly home? Anybody from a foreign country? A country that's not United States. Okay, so you fly home, and you would obviously try to pick the best price if you're going to fly home, right? No, you would pick the highest price? The mileage? What's that mean? Oh, brand loyalty. Okay, that's a concern too. And that's one reason they have the brand loyalty is to keep you flying, even if you have to pay more because you want to get those points to get the free flight. So you kind of get a cheaper flight later. You're just paying higher now for it. That's one reason when you fly today that they focus so much on lowering the price, but they don't tell you that there's a $50 bag check to check your bag, or a $25 charge to bring a carry-on, or if you want peanuts on the plane, there's a charge for that. Charge for everything. If you fly Southwest, you want to actually get on the plane and not sit in the bathroom, you have to pay the $12.50 to get the early boarding pass, or wake up exactly 24 hours and 10 minutes before the flight leaves, so you can get there and print out that boarding pass at that 24-hour mark. God help you if you forget to do that, because then you are in the C section, 50 to 60. And then you're getting on the plane, you can't sit with the person next to the person you want to, and you wind up sitting in the last row that has 2 babies in it and a dog. You can take dogs on Southwest planes. Did you know that? Dogs and cats. And that's the seat you'll have next to the dog and the 2 screaming babies that were left on the plane from a previous flight. That's a good question. I don't know the answer to that. Okay, earnings per share, and we have Cars LLC and Bloom have the highest earnings per share, which makes sense because they have the highest profits. Now, what's one way to increase? If everybody here had the same amount of net profits, what's one way to increase your earnings per share? You all have the same net profits. How could you increase your earnings per share if everybody had the same net profits? Right. We're going to say the. No, you want to retire equity, which is kind of retiring funds, but you want to retire stock specifically. So you were 1/3 right. So if you retire stock, you have a smaller amount of outstanding shares. So if you have the same net income, you have a higher earnings per share. Only one company went negative on their earnings per share. So they actually produced less earnings in this year than they did last year, which is very hard to do when you have double-digit growth in your revenues. So that's a complete management failure, and that company should reevaluate their priorities, especially their teamwork. Now, I have good news though. If you didn't do well in this round, since you have these year-over-year comparisons, you have an easier time doing better next round. Because just like if you have an an A minus average compared to someone who has a C minus average, who has a better who will have an easier time at getting a higher grade point average the following semester? You know, it's easier to go from C minus to B than it is from A minus to A. This is just a lollipop. That's what it reminds me of, one of those multicolored lollipops. So, okay. Let's go back. I'd like to look at the charts again here. And, okay, so the score ranges from 900 to 320 points. And the profit percentages, some companies, remember we started out at 40%. So some companies, all but 5 companies were able to increase their profit margins. And the companies that increased their profit margins from 40% and higher did better in points and in the overall simulation. But 4 companies actually had lower profit margin percentages, 39, 39, 36, 35, and 34. So these companies, and you've noticed these companies because they're the companies who have lower points, lower earnings per share, and disappointed investors pretty entirely, where they were disgusted with them and just wanted to sell their stock. So you didn't improve the company. And this is something that I did mention in class on Monday. So I don't understand how I mentioned that class on Monday morning and no, these teams didn't go back and adjust their sales and their costs and their prices to make sure that their average gross profit margins were higher than 40%, since I specifically pointed it out in class, and I point that out in every video I made for the simulation. So there's a real breakdown in listening, understanding, and direction of where the simulation is going. Something I think you can easily correct. All right. So would Noto and Bloom be okay if I put up your overview points and talked about them? It's no secret. People could see your scores, so I'm not revealing any secret information, but I just want to use, since you did well, I want to use you as an example. You have your permission? All right. See, I ask now rather than getting evaluation where it says, you know, professor picked my company apart in class and I was totally embarrassed and I hate his guts for it. It wasn't quite, that's not word for word, but so I'm going to enter your game. I have a back door into your game, and I'm going to go in through Brittany's account. And so now that you're in round 2, you have the industry results, which this is where you're going to get information on everybody else's car, exactly how they built it, what their ratios were, what their earnings and points, and this is where you want to go if you're a company that's in the lower end of the scale and you want to figure out how to elevate your company to the higher end of the scale. This is where you do your research. So start copying the best companies. They'll be one step ahead of you next round, but at least you could kind of catch up to them. So if you're the companies in the top end of the performance, you need to kind of keep improving your game. Don't rely on the same, don't build the cars identical to last round. You have to now start improving because as you know, the customer expectations are increasing. Customers, they're really horrible. They keep expecting more. You know, when I go to Chipotle Mexican Grill, I'm always expecting more meat and more beans, and I'm always asking, like, can I have a little more? You know, sometimes it works, sometimes it doesn't work because they're supposed to scoop out only a certain amount. Is that rude to ask? I'm hungry. And sometimes I don't feel like they put enough meat on there because it's like half a spoonful. I'm like, you gotta top that spoon off. Where's the manager? I'm hungry. You also have this assessment page here. And you guys got all these stars. So these assessments, so anybody who didn't do well, you can go into these assessments and open up the hints and get an idea of why didn't I do well. So you can open up the hints here under assessment and they'll give you hints on how to improve in these different areas for all of the ratios. And you guys, except for operational investments, you're kind of a little low on that. But that, I I kind of feel like everyone's low on that in the beginning, and this doesn't go up until you start. I don't think it's round specific. It only goes up as you start investing more as the simulation continues. So no one's going to have huge amount of stars in that area. Now cash management, you you have an average, which might mean too big of a surplus or too small of a surplus. I'm not exactly sure. But you know that once you look over your assessments and you kind of analyze the charting information in the industry, then you're ready to do your sales again. I would also, as this chapter completes, you may want to look over your financial statements, and there's also a cash flow statement in here, and your ratios. You may want to look those over too, just kind of reinforce what we're learning in this chapter. But the big story is on the overview page. I'm sorry if you can't see this, the numbers are quite small here, but what we're looking for is, everybody has the same year zero ratios and results. So we're looking for improvements in year one. So you improved your sales almost 100%, and you got close to 100 points for moving your revenues per share from 12 to about $24. So you get 100 points or 97 points for that. Your quick ratio, your debt ratio, you lost points because you issued additional debt. That can't be helped. You can't, and this is something I fight with students all the time. They want to know specifically why and how they can improve one ratio. But they have to understand all these ratios are tied together. So if you improve your debt ratios by paying them down, now you're not borrowing enough money to expand your company and buy factories and additional investments. Your company's going to suffer. So you can't do well in every category every round. It's a give and take. So you gave on the debt ratio so you could take more on expanding your company and investing in your company and growing your sales, and that's smart. So your profit margins went from 40 to 47, 23 to 30, and 16 to 21 on gross operational and net, which we covered last class, and you got almost 80 points for that, or more than 80 points for that. Your total asset turnover, your earnings per share increased greatly, and your market capitalization, your company was worth $50 million. Now investors feel it's worth $150 million. You had a surplus, and you made additional investments in your company. That's 200 points right there. And you improved on all of your forecasting. None of your forecasting was perfect, but you improved on the previous year's results. So you made money in just about made points in just about every category, and that's how you got up to 890 points. So now, if you're in a team where you may have lost a lot of points in any one of these categories, you need to go back and look at the formula. How is operation profit margin calculated, or how is return on equity or return on assets calculated? You could go back and see the actual formula, and then think about what you're doing, because when you put your the simulation together, you're going to get this pro forma financial statement, which is going to give you next year's financial statements. So you could actually go and take your next year's financial statements when you're done with the simulation and calculate next year's ratios. So this is a key insight if you want to make sure that you're improving your year over year. If your revenues per share here are 24, you can actually take your revenues from their pro forma, divide by your outstanding shares, and get your new revenues per share and figure out whether or not you're making or losing points. So you actually have control by calculating these ratios we talked about. You can actually calculate year two's ratios. Once you're done with the inputs for round two, you can actually go ahead in a spreadsheet, calculate year two ratios, and then compare them to year one and do a year over year calculation, which would be new minus old divided by old. So, for example, your old salary is $10 per hour. Your new salary is $15 per hour. So new minus old divided by old gives us 5 over 10, which is 50%. So that's a year over year change. So I think we all agree, if your salary is $10 per hour and it goes to $15 per hour, you had a 50% increase in your salary. This is how you calculate a year over year. And I like to say, YOLO, year over year, new value minus old value divided by old value. And that's how you calculate your percentage. So as a quick reminder how to calculate a year over year, something that you should have learned in 6th grade. But who remembers what you learned in sixth grade? Do you even remember your sixth grade teacher? I do. Her name was Mrs. Fry, and she had blonde hair. Okay. The okay, questions. I'm going to end the video here.